Hello everyone, welcome to a brand new webinar. Today I'm going to be talking about tricky retirement and Social Security scenarios. Now with regards to retirement planning and tax planning, those two things really do go together. It's difficult to plan for your retirement if you're not planning for the tax impacts as well of retirement savings and RMDs, both contributing and withdrawing from your retirement accounts when you get to retirement age. What you'll find in this business, if you've been in this business long enough, is that as taxpayers get older, your client base is going to grow with you. And as your clients get older, you will find that they're going to be asking more and more and more questions about retirement planning, Social Security and Medicare, and how to fund their golden years. You should be familiar with these topics, not just because it will help you serve your clients better, but because many of these issues that we're going to talk about today have a significant tax impact, and they do impact the taxpayer's return. So these are real scenarios that I'm going to be discussing with you today. But all of these scenarios, all of them are scenarios that would impact a taxpayer's tax situation as well as their retirement planning or their retirement situation. I have a really good group that I think you should join. It's called Retirement Planning Education, formerly called Taxes in Retirement. The administrator of the group is a certified financial planner as well as an enrolled agent. And this group is excellent. It has tens of thousands of members at this point. And many of the members are, just people in the general public. It's not strictly a professionals group. Like most of the groups that I belong to are strictly for tax professionals or, enrolled practitioners. It has a lot of enrolled practitioners, but it also has a lot of just regular taxpayers that want to learn more about retirement planning. But I've learned a lot in this group. And what it's done for me is that it's helped me understand scenarios that I never would have thought of. Sometimes people come up with stuff and I'm like, how did this possibly happen to you? Like people who've been scammed out of their retirement savings, unfortunately, taxpayers who are dealing with, a spouse that has dementia, taxpayers who are interested in trusts and whether they should have a will or a trust or both. And there's really good questions in this group. And there's also many enrolled practitioners, both attorneys, enrolled agents, and CPAs, who offer their professional opinion and advice. It's a great resource. I suggest that you join, especially if you want to learn more about retirement planning education in general. All right, now we're going to go into the client scenarios. This is a scenario that I've heard on multiple occasions, and I've had clients ask me this question specifically too. So if you haven't heard this question already, eventually it's going to come up. There's a beneficiary who is the beneficiary of the parent's retirement account. They've already inherited it. So usually this is like an adult child. The parents have died, the children are adults, and they've inherited their parents' retirement account, like a 401k or a traditional IRA. Because, if you have a retirement account, one of the first things that you do when you set up a retirement account is you name your beneficiaries. If you don't name your beneficiaries on your retirement account, then what will happen is that retirement account will pass to an estate. So the parent has passed away in this scenario, and the taxpayer receives all of the retirement funds. What they did is they withdrew the money from the retirement account and gave $10,000 each to their two siblings and a niece. Okay, so $30,000 they withdrew and gave to the two siblings and a niece. Not sure if there was a will stating this, how the retirement money was supposed to be given out, but if there was a will, wouldn't the financial company take care of splitting the money amongst the beneficiary plus the two siblings and the niece would each get a 1099-R? That's not how it works, people. Doesn't matter what your will says. In fact, if you have named beneficiaries on your retirement account, it's going to pass to those people directly, to the beneficiary that's actually on the retirement account. Now, if this was a verbal agreement between the parent and the beneficiary would be getting all the money plus the 1099-R, and the two siblings and the niece receive a tax-free gift that the beneficiary alone is paying taxes on. And that's exactly what it is. Because only one beneficiary, the adult child, inherited this retirement account because there was only one named beneficiary on the parent's retirement account. And many times this will happen because the parent will just name one sibling, or the parent will just name one child. Okay, many times this is how it happens. Okay, parent has a retirement account. They have one child who's like their favorites, or their child that they feel like is the most responsible one. Sometimes it's the older one, or sometimes it's a person who maybe has some experience with tax or, accountants or whatever. And what they do is they just name that one person as the beneficiary on their retirement account. And then they tell that person, hey, when I die, I want you to make sure that your brothers and your sisters get part of this. Okay, that's what they do without realizing the tax impact, because that one named beneficiary is the one that's going to take the entire tax hit if you're going to do it that way. If you only name one beneficiary, then that one beneficiary is going to inherit all of the retirement funds, and it belongs to them. They can do what they want with it. But if they feel like, okay, my parent told me that I have to divide this up, then they can do it, but they're not going to be able to pass that tax impact to their siblings or whoever it is that they want to give the retirement account to. They can say, okay, I'll give you less money because I got to pay the tax on all of this. But people don't think about that. Many times they just distribute everything and they don't realize that you can't pass the tax impact to those other people. The person who inherits the retirement account is the one that is going to get the 1099-R. They're the ones that are going to have to pay the tax on the distribution. And then what they do with the money afterwards is up to them. But the money that this taxpayer gave to the two siblings and the niece, that's just a gift. It's not taxable to the person that he gave it to. And you can't pass the tax impact to somebody else. He has to pay all the tax. So retirement accounts have listed beneficiaries. If the parent wanted the children to receive the funds, then they should have been listed as proportional beneficiaries. And this is something that you can set up very easily in your retirement account. I know, I just did it like last month. And I have Fidelity. I have a SEP IRA through Fidelity. I'm not like promoting them or anything. I just happened to set it up with Fidelity. You can name your beneficiaries and also the percentage of the retirement account that's going to go to those beneficiaries. So, I have my spouse and my children. And then I also have, provisional beneficiaries. If we all die in a fiery crash, like my husband, my kids, me, all of us, if we all go on the same plane or in the same fiery crash, then my brother gets it all. Okay, so he would be like a provisional beneficiary after all of us, after my husband and my kids. So you can absolutely set that up in your retirement account where a percentage will go to each child. But that's not what this parent did. They only listed one child as the beneficiary of the entire account. If one child is listed as a beneficiary and wants the other siblings to have the funds, they can either, one, take a distribution, report it in full on their tax return, and then gift it to the siblings. This would not be a reportable gift in this scenario because it's only $10,000 each. You wouldn't have to file a gift tax return is what I'm saying. So it wouldn't be reportable, but the person who actually inherited the retirement account is the one that's going to take the tax hit. They're the ones that are going to get the 1099-R. And then the other choice is to disclaim the retirement account within 9 months. You can actually disclaim an inheritance. Did you know that? You don't have to accept an inheritance ever. You don't have to be an executor for an estate, even if you're named an executor in a will or in a trust. You don't have to do any of it. You could say, I don't want to do this. You can disclaim an inheritance. You can say, I don't want the inheritance. You can also not serve as an executor. Nobody can force you to do anything. And nobody can force you to take money either. And sometimes people will walk away from an estate, especially if the taxpayer or the deceased had like a lot of tax debt or a lot of messy stuff going on. Maybe they have a lien. On more than one occasion, I've had children that just said, the house is like run down. And my parents left it to me, but there's a tax lien that like is almost the value of the house. I'm not going to deal with it. I'm walking away because the cost of like the legal fees and setting up probate and everything else is worth more than the value of the entire estate. So you don't have to accept any kind of inheritance. The beneficiary can disclaim the retirement account, can disclaim the inheritance within 9 months, And if there's no contingent beneficiaries, the retirement account would then pass to the estate, and the estate would receive the distribution and pass it out according to the will. So those are your two options in this case. This other tax practitioner said beneficiaries on a retirement account make it so that they aren't governed by a will. So you can have a will, but if you have beneficiaries listed on your retirement account, it's going to pass to whoever you listed on your retirement account first. I have heard recently of one scenario where it was a parent who had listed their children as beneficiaries on their retirement account, but both of the parent was already elderly, but both of the children actually predeceased the parent. So the beneficiaries died, and the parent didn't update the beneficiaries on the retirement account. So then in that case, also, the retirement account would then have to pass to the estate, because there was all the beneficiaries that the taxpayer, the parent, had listed had already passed. So in that case, it has to pass to the estate, and then the retirement account would be distributed according to either the will, and if the taxpayer didn't have a will, then according to state law, right? So if there's no children, then it would pass to, the closest living relative, grandchild, a sibling, whatever it is in that state, the state law. As long as the beneficiary is the one who divided the money, they will be the ones to get the 1099 and owe the tax. And then it says right here, this practitioner asked, what institution would go against the trust instrument that named the beneficiary? And then this other practitioner responded, the trust instrument can name anything it likes, but the IRA trustee must and will follow the beneficiary designations they receive directly from the account holder. It doesn't matter what you put in your will or your trust. Those are documents. They're legal documents. But if you have listed beneficiaries on your retirement accounts, it's going to go to the listed beneficiaries on your retirement account. The trustee has to follow the beneficiaries that you've listed on your retirement account. And the only time when it would pass to an estate rather than the beneficiaries that were named is if the beneficiary disclaimed the inheritance, or if the beneficiaries themselves had already passed away. Okay? And then the beneficiary is the one who would get the money and pay the tax. Does not matter what the will says or the trust. The will would matter if the estate was the beneficiary. What I have done in the past is calculate the tax and have the client give the shares to the others minus the tax. Now that would be the smart way to do it. But the tax impact or the tax hit is going to go to the beneficiary that actually inherited the money. And then what they choose to do with the money afterwards, that's a gift. Okay? Can't pass the tax impact off to anybody else. I've heard of people say, can you nominee it out? Or no, he can't do it. That's not how it works with retirement plans, inherited IRAs. That's not how it works. Farmland inheritance. This taxpayer had questions about inheriting farmland. Fishing for ideas, he said. We are likely to inherit $350K of productive cropland. So this is the value of the land that will likely kick out $20,000 in annual farm rent. So the farmland is actually being rented. It's being rented, and it earns $20,000 in annual farm rents. Now, this is passive. Farm rental income is typically passive. It's not subject to self-employment tax. So this would be a fantastic annual revenue generator for him, obviously. $20,000 in annual farm rent in just passive revenue is nothing to sneeze at. That's pretty good. We both have defined benefit pensions. Now, a defined benefit pension is like what you get working for the government. Like my father has one. He was a teacher in California for more than 30 years. And a defined benefit plan is not like a 401k or a traditional IRA. It's a set payout basically for your whole life until you die. You get like $2,000 a month or $3,000 a month. That's a pension, and you get it as long as you're basically alive. It's not based on how much you've actually contributed. They also have 401k and 403b accounts, so our retirement will likely be financially secure. So defined benefit pensions or defined benefit plans are rarer these days, but people who work for the government, like the federal government, or people who work for the state, or teachers, they still get them. Also postal service employees, they still get them. So his retirement is secure, and he's married. He actually mentioned that later on in the post. So he's married. he and his wife both have, secure retirement pensions as well as a 401k and a 403b. So they're going to be okay. Basically, they're not going to be desperate for money. So they want to know what kind of tax planning they have to do when they inherit this land. Question number 1, are there tax issues relating to the inheritance of the land? Read as, do we need to be prepared for a significant tax bill that would force us to sell some of the land? Question number 2, are there ways to tie up the land to ensure it can be passed down to our children one day? If one of us dies early, how do we ensure the land passes to our kids when the other of us dies and doesn't get fouled up by a second marriage? So he's thinking, if one of us goes, I don't want it to go to like the new guy if I were to die, which is understandable, right? You want to make sure it passes to your children and not, a second spouse. Question number 3, are there any corporate structures that would offer tax advantages for the monthly rental income? Read as, do we want to form an LLC, S Corp, or C Corp? Thank you. Okay, so I answered this question. There were other answers, but I'm going to give you mine. Question number 1 was about the inheritance. Inheritances are not taxable to the recipient. If you plan to sell the land, then you will get a stepped up basis. So they will get a stepped up basis on the land, and it's $350,000, which is, that's great to inherit $350,000 worth of land, but there's not going to be any estate tax. This is nowhere near the estate tax limit. So this is not going to be a taxable event, this inheritance. The inheritances are not taxable to the recipient. There's not going to be any estate tax. If you plan to sell the land, then you will get a stepped up basis. So unlikely there will be any capital gains on the sale to the heir or the beneficiary. Inherited property is given beneficial tax treatment, right? So if he wanted to sell it, he'd get a stepped up basis, and he would have either a capital gain or a capital loss. And any gain or loss would be based on the difference between the sale price when he actually did sell it and the fair market value on the date of the decedent's death. So usually if there's a capital gain or a loss, it's really minor unless the taxpayer actually chooses to hold on to it for a long time after the death. I know that sometimes you can have a large change in value, especially if you have like a very hot real estate market. There's some areas where the real estate values fluctuate a lot. And I have seen a couple of recent posts where, somebody inherited a house and then waited, a year to sell it, 9 months, and it had already gone up in value considerably, $50,000, $75,000. So that's a considerable capital gain on inherited property. But typically, you're not going to see anything close to that, especially if the person inherits and then sells it, within the same year. There's going to be a little bit of change, but generally it's not these huge fluctuations in real estate value. Now, answer number 2 is if you want to hold on to it and pass it to your children when you die, many people do choose to do that, especially with something like farmland. They want to keep it in the family, especially if it's a family farm and they've been farming, the land for a long time or for generations even. They want to keep the land in the family. If you want to hold on to it and pass it to your children when you die, your children will also get a stepped up basis on the land. A trust is the best way to protect the land and make sure it doesn't get passed to someone you do not want. Typically what people do when they want to keep something like this in the family, like farmland or a building or whatever, is they will get a lawyer. The lawyer will form the trust and then put those assets into the trust. Basically whatever they want to keep. In this case, it would be the farmland. You can name the beneficiaries of the trust. You can name trustees. You can outline the terms of the trust any way you wish. And that's the best way to make sure that this asset, which is the farmland, doesn't get passed to someone that you don't want, such as like an ex of your child or, whatever. That's what trusts are for. Now, number 3 is about the corporate structures. There are no corporate structures that offer a tax benefit for holding appreciated property. Property that continues to go up in value, like land or a building. You don't want to put those in a corporation if you can avoid it. So putting raw land into a C Corp or an S Corp, either one, is a terrible, terrible idea. Because getting it back out of a corporation is difficult. When you distribute appreciated property from a corporation, it's treated as a sale to the shareholder. So you don't want that. You want to avoid that. So a trust would probably be the best entity type for this person based on what they want, based on what they're talking about. And then I also added one more comment. FYI, holding the rental property personally and reporting the passive rental income on your individual returns is the best tax treatment you're going to get. Because this is like a Schedule E passive rental. It's not a house. It's not a residential rental. It's a farmland rental. But it's passive. It's passive. It's not subject to self-employment tax. Basically a sweet passive revenue generator. I wrote this. Personally, if it was me, and I inherited this land that was making $20,000 a year in passive income, I would just hold on to it. I wouldn't sell it. I would hold on to it. You know, I've got kids. I would want to pass it to them, right? And I would want to pass it to them with a stepped up basis. So I personally, if it was me and I inherited this land, I would hold on to it. I would just take the money every year. I would just get good liability insurance on the farmland to protect against legal claims. And that insurance, that liability insurance and hazard insurance that you would get on the land would be fully deductible as an expense on Schedule E. So this would be like a Schedule E rental if he was renting it for a flat cash amount. If it was a share crop rental, then there's a special form, but it's still passive. So if it was me, I would just hold on to it personally, and I would get good insurance to cover liability against legal claims. And that's it. That's what I would do. I would never put it into an S corporation or a C corporation. I wouldn't. Okay, seniors and scams. So we're talking about people that are in retirement age. And what you'll notice, unfortunately, as you work in this business, especially if you have older clientele, you will have experiences where these clients are victimized. And many times they'll be victimized in a way that creates a very negative tax impact. This is a situation that I've heard of on more than one occasion just in the last year. It's common for seniors to be targeted for scams, for scammers, for ID theft, for phone scams, for retirement scams, lottery scams. I've heard it all. Okay, and it happens more to seniors than really to anybody else, partly because I think there's a belief that a senior maybe isn't as technologically savvy. They might not know really how to navigate computers or, modern technology, and they might, trust people that maybe they shouldn't trust. They haven't encountered things like modern scams. 20 years ago or 30 years ago, you never would have imagined that someone would call your house pretending to be the IRS. I'll just tell you that right now. Like 25 years ago, that just didn't happen. There was no such thing. There was other types of scams, but nothing like what happens these days, like online scams and email scams and phone scams, people claiming to be the police, people claiming to be the IRS. 25 years ago, none of that existed. It just didn't happen. So we do hear of many cases, at least me. I have 2 ID theft cases on my desk right now. And I do hear of seniors kind of on a regular basis being targeted for scams, especially retirement scams. This user posted a particular scenario that he encountered. And there was really good solutions offered in this group, so I wanted to share it with you. Matthew says, I have a client who pulled out of her retirement account due to a lottery scam. The client voluntarily pulled the money out and sent it to the scammer. She was over 59 and a half, but still, of course, was taxed on the proceeds she voluntarily pulled. So she was targeted for a lottery scam. They'll call and they'll say, oh, you've won the lottery. You just have to pay the tax in advance or whatever, like BS line they come up with. It's all lies. It's all lies. But these people believe it. She pulled money out of her retirement account because she was targeted for a lottery scam. She owes around $21,000. That's the tax that she owed. Okay, that's the tax that she owed, which means she pulled out like over $100,000 and it's gone. She lost it all. She qualifies for CNC, which is currently not collectible. Once you start doing representation work, you'll learn a lot more about these types of acronyms. Currently not collectible means the IRS can't collect because you basically don't have anything left for the IRS to collect. But neither the client nor the client's sister, who I primarily communicate with, the client is elderly and does not understand finance or tax issues, which is another reason why, seniors get targeted. Many times they're not financially savvy. And then coupled with not being technologically savvy, they get scammed a lot more than, younger people. I'll just say it like that because it's true. Seniors do get targeted more and they get scammed more, many times because younger people can kind of sense that it's a scam. They know. The client, they don't want a lien on the client's house. So this is what they're trying to avoid, even if the taxpayer actually does qualify for CNC, which is currently not collectible. I am considering having the client pay off some of the balance below $10,000 and setting up an SIA, which is like an installment agreement, and attempting to abate. Okay, but I think the lien would be unavoidable. OIC doesn't make sense. OIC is offer in compromise. That's when you submit an offer in compromise to settle the tax debt for less than what the taxpayer owes. I was looking for some kind of court case or guidance for situations involving scams, but I cannot find any. Wondering if any of you have had a similar case. Does anyone else have a strategy given the client's sad situation? Okay. Greg responded, we have just successfully completed an OIC ETA. This is an offer in compromise under effective tax administration. This is the rarest type of offer and the least likely to get accepted. But in this case, the taxpayer is elderly and she was the victim of a scam. This is not someone who is doing this intentionally, and she lost all of this money. She doesn't have any money left to pay the IRS, and she's just trying to save her primary residence. So that actually, I think, would be a good basis for an OIC under effective tax administration, even though this is the most difficult type to get accepted. Greg goes on to say, our client lost $750,000 to a scam and had just enough assets left to pay the tax. He was 70, and paying the tax would have wiped out all of his remaining assets. If paying the tax causes a hardship, OIC ETA might work. This user responded, very interesting. You don't see very many OIC ETAs. This is once again effective tax administration. Do you think that the IRS would have still accepted it if you would have done a DATC offer? This is doubt as to collectability, because doubt as to collectability means you're submitting an offer based on the fact that the taxpayer doesn't have the assets to pay the debt. Greg responded, he had savings in excess of the tax, so we did not go DATC. And then Craig said, this group rocks. I keep picking up little nuggets of info to think about in every case. Thank you, sir. And this was actually from one of the representation groups that I belong to, not the retirement group. But it is a senior issue, so I feel like this is something that I should talk about in this webinar, because you're going to encounter seniors that have been the victim of scams. And sometimes they will owe tens of thousands of dollars and sometimes even hundreds of thousands of dollars because they've been scammed out of their entire retirement account. I've heard of situations like this with even higher dollar amounts, where it was one lady who was the victim of a scam. She thought that she was like communicating with the FBI, if you can believe it. They contacted her and said, we're the FBI and we're trying to protect you. It's just horrible. She believed them. She thought it was like the FBI or the police that she was talking to. She ended up transferring almost $1 million. I think it was $950,000 out of her retirement account to protect it from a scam. And the scammers are the ones who were talking to her the whole time, and she lost everything. She lost her entire retirement account. It was gone. All that was left was her primary residence, and then her little amount of Social Security was all she had left after that. So she lost everything. You're gonna encounter situations like this, and sometimes the solution is to either get the person into currently not collectible, which is something that you can request from the IRS once you start doing representation work as an enrolled agent. This is part of representation work that you will do as an enrolled agent, or to submit an OIC for this type of person, either under effective tax administration, which is difficult to get approved, I'll tell you honestly right there, or doubt as to collectability, which is when you submit an offer based on the fact that the taxpayer cannot pay the debt. They don't have the assets to satisfy the debt. Now we're going to talk about the Form 5500, which is a reporting requirement for certain types of retirement plans, retirement accounts. Most commonly, you will see them with something like a 401k, especially with a solo 401k. This is a really serious danger. Now, one of the reasons why I recommend traditional IRAs and Roth IRAs and even a SEP IRA to business owners rather than something like a solo 401k, which would allow them to sock more money away for their own retirement, is because of the additional compliance issues when you have a 401k or any ERISA plan. Okay, any plan that has an additional filing requirement. And what I'm talking about is the Form 5500. This is a retirement plan that has to file an annual information return. It's not a tax return. The 5500 is not a tax return. It's an information return only. But the penalties for non-filing on this type of return are off the charts. I mean, it can be thousands upon thousands of dollars. If the taxpayer does have a business and they have a retirement plan, like a 401k, like a solo 401k or a simple 401k that has a filing requirement and they don't do it, if they don't file the Form 5500, the penalties can be huge. Tens of thousands of dollars, even sometimes hundreds of thousands of dollars, if you can believe it. And I'm going to go through this post first, and then I'm going to show you where the penalties are, because they can be assessed by the IRS as well as the Department of Labor. David writes, I have a new client that closed his 401k profit sharing plan in 2017. This was a long time ago, folks, 2017, that he was the only participant in the plan. So this is usually like a solo 401k that a person has, and they have like an S Corp, right? So you're a single shareholder in an S Corp, and you have a solo 401k. This is really commonplace. This is probably what the scenario is. So he closed his business down, or he closed his 401k, and the IRS is claiming they never received his Form 5500 for 2017. And sometimes it will actually take years for them to issue a notice. And in the meantime, the penalties will continue to accrue. The IRS is claiming that they never received his 5500 for 2017 and since have assessed a $150,000 penalty for not filing this form. $150,000 penalty for not filing this form. I need help on strategy as to what the best steps are to get this addressed and abated. He had less than $120,000 in the plan, and they are assessing a penalty that is in excess of the plan assets. So the penalty is higher than the amount that he ever had in the retirement account. He's not happy about this, right? Thank you in advance for your guidance. Okay, John says, I assume he used to have much more money in the plan, correct? It is my understanding that if the balance is less than $250,000, then he is not required to file a 5500. But per the link above, it looks like the termination year makes a filing requirement, so the year that you close down the plan. Posted for others learning on my own, all plan sponsors, regardless of plan asset value, must file a final return for the year their plan is terminated and all assets distributed. David says, thank you for your comments. I will definitely learn from this case. Now, there are things that you can do. There's relief options with regards to non-filers for this. But this is a really serious penalty, folks. This is something that you really want to try to avoid. And I don't do these personally. I don't do 5500 forms. I always refer these out. I think that a traditional IRA, a Roth IRA, or even a SEP IRA, which doesn't have this filing requirement, is a better choice, especially for people who don't want to deal with this sort of thing, because the Form 5500 is rather pricey to get done. I've had tax practitioners and also even clients themselves say that this form is no big deal and it's totally fine. You know, it's easy to do if it's just a solo participant plan. And you might feel that way. You know, the form is pretty simple if it's just one participant in the plan. But, you know, I feel like the penalties are so huge that, I don't know. I don't know if it's really worth the risk, especially if it's a solo plan and you miss 1 year, or maybe the form doesn't get submitted correctly or whatever, and then you're dealing with, you know, $150,000 penalty. That's crazy. Now, here I am on the instructions for the Form 5500 EZ. These are the IRS instructions for the 5500 EZ. This is the simplest form This is for single participant plans. So basically like a sole shareholder S Corp that has like a solo 401k and they need to file this form. I want you to look at the penalty amounts. If I scroll down, it says down here, penalties. Section 6652E imposes a penalty of $250 per day. Larger plans, it's higher, up to a maximum penalty of $150,000 per plan year for not filing returns in connection with pension, profit sharing, etc. plans by the required due date. So in that post that I was referencing, where it was a 2017 unfiled return, basically they just assessed the maximum penalty against him because the penalties just kept accruing and accruing and accruing until he reached the maximum, because it was 2017. So who knows when the IRS ended up finally sending him a notice? Could be years down the road. So you don't want this to happen. If you have a person who actually does have something like a solo 401k or a simple 401k, you want to make sure that they realize that most of the time those plans do have a filing requirement, especially if they actually do get shut down or dissolved. You have to file in the final year. And if this is not something that you want to deal with, you have to find someone to refer these out to. Okay, but traditional IRAs, Roth IRAs, and SEP IRAs don't have this requirement. Oh, and simple IRAs don't either. So those are all, retirement plans that don't have additional filing requirements. People can make mistakes with those retirement plans. They can, over contribute, or they can contribute when they don't have qualifying compensation. But typically those issues are easier to fix, and the penalties are not as severe as non-filing when it's a 5,500, just to be aware. Now let's talk about a mostly retired farmer who wants a little bit of earned income. Now what you'll notice once you've been in this business for a while is that when people are younger, they really want to avoid self-employment tax and payroll tax any way they can. They want to have as much passive revenue generation and capital gains as possible, because you don't have to pay payroll tax, you don't have to pay self-employment tax on those types of income, and at least with capital gains, those are taxed at a beneficial tax rate as well. However, you will notice as taxpayers get older and older and closer to retirement, and even after retirement, many times they still want to fund a retirement account like a Roth or a traditional IRA, but they don't have any earned income, so they can't. Many times, these types of taxpayers will get like a little part-time job. They're retired, they're on Social Security, or they're receiving a pension. They'll get a little part-time job, making a couple $1,000s a year, or a little side gig, a little Schedule C business, selling Avon, or, doing little repair jobs or something like that. Or like this particular example, a farmer, he's just doing it a little bit part-time. He's retired. He buys and sells a few cattle every year, like he says here. I have a Schedule F, but for the last 2 or 3 years, TurboTax says just file with the standard deduction. So this is a taxpayer who doesn't understand that the Schedule F and the standard deduction really have nothing to do with each other. The standard deduction is what you take when you don't itemize. When you itemize, that's when you're deducting mortgage interest and property tax and medical expenses and that sort of thing. That's when you itemize on Schedule A. When you don't itemize, or you don't have enough to itemize, which actually does happen quite a bit to retired people because many times their houses are paid off when they're older, so they don't have any mortgage interest, and the standard deduction tends to be higher for them. So they take the standard deduction. But if you're self-employed, you still got to file either a Schedule F or a Schedule C. The threshold for filing when you have self-employment income is actually only $400. And a lot of taxpayers don't understand that. Many of them think that the threshold is the standard deduction amount, but that's not true. That's only if you're like a wage earner, because when you're earning wages, or when you have other types of income like just rental income or passive income, like even a pension or money from Social Security, you don't have to file if you're under the standard deduction amount, but that's because either the income is not subject to payroll tax or it's not subject to self-employment tax. And if you're self-employed, you have to pay self-employment tax. And that filing threshold kicks in at $400. It's very low. It's not $600, everybody. $600 is the filing threshold for when you have to send out a 1099 NEC to a contractor. That's not the same threshold for when you are required to file either a Schedule F or a Schedule C when you're self-employed. Now, many people, when they get older, they really want to fund their retirement accounts, so they'll pick up like a little side job or a side gig in order to do so. That's exactly what this person is doing, but he doesn't want to bother filing a tax return anymore. That's the kicker here. My question is, how do I put about $1,000 to $2,000 annual profit from selling cattle into my Roth account? Is there any issue to be aware of? Now, you can't fund a Roth or a traditional IRA or any other type of retirement account, actually, if you don't have some form of earned income. You have to have some form of earned income. He says he's retired, so presumably he's getting either pension income or Social Security, or maybe a little bit of both, but that type of income can't be used to fund a retirement account. If you want to put money into a Roth or a traditional IRA, you have to have some type of earned income. Now, the income that he generates from selling cattle and reports on Schedule F is qualifying income. But he doesn't want to file a tax return because many times people, when they get older, they're tired of paying for TurboTax. They don't want to pay for it anymore. They're not even paying for a tax professional to do it, but they don't want to pay even the $40 or whatever it is for TurboTax. He wants to be able to fund his retirement accounts without reporting the earned income. And then he edits it later in the post, because he got a lot of posts that said, you got a lot of comments that said, you still have to file a tax return. You still have to file a tax return. He wasn't liking that response. And that's what everybody told him. And then he edited it and he said, can I put the small profit from the cattle hobby into an existing Roth? Oh, now it's a hobby. Before it was a business. Now you're saying it's a hobby because you don't want to file a Schedule F. Okay. This is my answer. You have to file the Schedule F in order to report the earned income. That is presumably the only qualifying income you have to contribute to a retirement account. It's just the income that he has from selling cattle. The standard deduction has no bearing on whether you have a filing requirement in this case. He doesn't understand that. Your filing requirement is triggered by your self-employment income, which is the income reported on the Schedule F. The filing threshold for self-employment income is only $400. I suggest you continue to file your return, reporting your small amount of farming income, and use that money to fund any retirement account that you wish. And he didn't like any of the answers because he didn't want to file a Schedule F. He didn't want to pay for TurboTax, I guess. And he still wanted to fund a Roth or a traditional IRA, but not have to report any earned income. But you can't do that. Still got to file the Schedule F if he actually is in business. I mean, he has an annual profit every year. So obviously he has a profit motive in this activity, even if it's a little part-time gig. He still has to file the Schedule F, and that's especially true if he wants to fund a retirement account. Because he needs that earned income. He needs to report it, and then he can use that income to fund a Roth. All right. Now, here's an issue that comes up pretty frequently. I'm actually kind of shocked by how many tax practitioners don't know that this is true. I've known this for a really long time, and that's because I've had to help family members with Social Security issues on several occasions. You can correct your earnings record. Let's just say that when a taxpayer gets older, when taxpayers start to get close to 65 or 62 even, they start to think about Social Security, even before then. Many times, this is the first time they will go into the SSA. SSA.gov is the Social Security Administration. You can pull your Social Security records or your Social Security statement right off the Social Security website. I'll admit that I actually didn't do that until I was in my 40s. So many people, when they're younger, they don't think about it. I mean, 65 seems so far away. right? And then as you're getting closer and closer to it, it seems like you're like running towards that age at breakneck speed. At least it is for me, right? I'm almost 50 and I feel like I'm like just running towards 65 in a sprint. So many times people will go onto the Social Security Administration website and they will pull their Social Security record and they're kind of shocked by what's reported on there. Many times unpleasantly shocked by what's reported or not reported on there. Now, one of the big issues that you will find when taxpayers are chronic delinquents, when they don't file tax returns, is many times those people are working under the table. By under the table, I mean they're working for cash wages, they're not reporting their income, or they're self-employed and they are receiving 1099s, but they're not filing tax returns and they're not reporting their income. Now, if a person is earning wages and they're getting a W-2, that information is reported to the Social Security Administration as well as the IRS, and you are getting credit for those wages, even if you don't file a tax return. Even if you don't file a tax return, those wages are being reported. But if a person is self-employed and they're just earning cash, or even if they are receiving a 1099, you have to actually file a tax return in order to report that income and pay your self-employment tax. Your self-employment tax that goes on the Schedule SE is the Social Security that you pay and the Medicare that you pay when you're self-employed, and that goes into your Social Security fund so that when you turn 65, you can get Social Security. That's your retirement. However, many people who are self-employed think they're like getting one over on the government. They might be making money under the table and they're not filing tax returns and they're not reporting that self-employment income. Now, if you don't report that self-employment income and you don't file tax returns, then the Social Security Administration assumes that you made zero. Even if the IRS is collecting or trying to collect, if you don't file a tax return and you are self-employed, nothing is going to get reported to the Social Security Administration. And you only have a certain amount of time in order to correct your Social Security record. And many times people let this go until it's too late. So I'm going to give you this scenario and I'm going to explain it because I feel like this is a question that comes up a lot and it's very highly misunderstood, not just by taxpayers, but also tax preparers. Now, the person who posted this question, her name is Karen, and she's posting on behalf of a friend who's an older man who turned 70 years of age. I'm inquiring on behalf of a friend regarding Social Security retirement benefit calculations. He just turned 70 and has started collecting Social Security retirement. However, his benefits were calculated using tax returns filed pre-1998, a long time ago, over 20 years ago. He obviously had enough quarters to qualify for income. Now, quarters is like payroll quarters. There's 4 quarters in a year, and you have to have at least 40 quarters of working, basically, in order to collect Social Security. Most people do have that. It's 10 years of working. I've been working for 30 years. I have plenty of Social Security quarters, but you have to have at least 40 quarters in order to qualify for Social Security. Now, he had enough quarters to qualify for Social Security, but only based on earnings pre-1998. He has not yet filed tax returns for years 1999 through 2022. He didn't file tax returns for over 20 years. And sometimes you will get these crazy delinquents like this. Didn't file tax returns for over 20 years. Too long of a story to get into here. Yeah, I know the story. I've heard this story a lot. It's somebody who is like working under the table and they didn't want to pay tax. And now they're collecting Social Security and they're really mad that they didn't file tax returns for 20 years because they're getting like a little piddly Social Security when they could be getting thousands upon thousands of dollars more if they'd just been filing tax returns along the way. Okay? Yeah, I know the story. It's a long story, but it's a common story. I've heard it more than once. Okay. He is now working with a CPA and hopes to file all back returns this year. He's going to go back and file 20 years of tax returns. Okay. Most of the time, you don't have to do that. For compliance with the IRS, it's usually you go back 6 years, although some states you have to go back farther. If it's a California resident, you have to go back forever, basically, because California has a 20-year collection statute. But with the IRS, usually for compliance purposes, you go back 6. Okay. However, here's the question. At the time of his phone interview with the Social Security, he informed the agent of his tax situation. And the agent told them that when he files back taxes, the SSA, which is the Social Security Administration, will only recalculate his benefits based on the last 3 years of returns. He did not get this information in writing. His CPA has never heard of this. This isn't a very good CPA, by the way, because all the CPAs that I know that are experienced and enrolled agents that are experienced know at least this about Social Security. What's the 3 years, people? That's the refund statute for the IRS. And that's also the same statute for correcting your Social Security wages or your Social Security reported income. Okay? This is the same statute. His CPA has never heard of this, and he's tried consulting with Social Security attorneys, but the 3 that he's spoken to, that he talked with 3 attorneys, this information is all on the Social Security website. It's right there. You can just Google it. He's spoken with 3 attorneys, but they deal mostly in Social Security disability. Does anyone have any ideas of who to talk to and how to confirm whether this benefit recalculation will be based on only the last 3 years of returns? Thanks in advance. So he talked to 3 lawyers plus a CPA and nobody knew the answer to this, which seems shocking to me, but okay. This person responded like this, and he actually was correct if the person was a wage earner. Frank put his benefit calculation will be the same calculation as everyone else, his top 35 years. So Social Security will take the top 35 years of earnings to calculate your Social Security benefits, how much money you're going to get when you retire, with earnings prior to age 62 being indexed for inflation. When he files the late returns, any of those that are part of the top 35 years will count towards his benefit calculation. And then he edited afterwards, I forgot that SS or Social Security will not correct records that far back. See later comments for details. Now, he was correct in that the Social Security Administration will take your top 35 years of working and use that to basically calculate your benefits. But it's the 35 years that you actually reported. You gotta report it. Now, if you are a wage earner and you have a W-2, then that income does get reported to Social Security. It's going to be reported by the employer. You don't have to do anything, right? The employer is the one that files the W-2s. And then you use the W-2 to file your tax return. That's a separate filing. The employer files the W-2s, not you, right? The employee doesn't file W-2s. The employee uses the W-2 to file their tax return with the IRS. But the W-2s are filed with the Social Security Administration. So the Social Security Administration has that information if you got a W-2. But if you're self-employed, then the way that you report your earnings is by filing a tax return and by filing a Schedule C and a Schedule SE. The self-employment tax is Social Security and Medicare. And that's what gets reported to the Social Security Administration. But I had a sinking feeling when I read this. This guy went 20 years without filing a tax return. How do you get away with that unless you're just working under the table? I had a feeling that that's what it was. So this was my response. If he was self-employed or working under the table rather than a wage earner, then the SSA operator was correct. If he had wages reported to the SSA, which is the Social Security Administration, then those amounts would be included. An easy way to confirm this is just to go to the SSA website and see if there are years with 0 reported earnings. And I'm going to show you what it looks like. I'm going to show you what a normal Social Security statement looks like. Well, normal, like a person who's continually working, and then also a Social Security statement where a person has many years with no reported earnings, and then it's just listed with a 0 there. And just having even a few years with zeros where either the person was not working or didn't report any earnings can sometimes really affect a person's eventual Social Security benefit. Many times people don't think about this until they get close to retirement age. And by then, usually it's too late to correct it. I mean, this is 20 years of unfiled returns, more than that, 1999 to 2022. He can correct the prior 3 years, but that's it. This is right on the SSA website. I kind of got a little dig in here. The CPA really should know this. It's public information. It's right on the Social Security Administration website. I put it into Google and it came right up 10 seconds later. So it's really easy to look this up. And it says, this is a quote, "An earnings record can be corrected at any time up to 3 years, 3 months, and 15 days after the year in which the wages were paid or the self-employment income was derived." And then Karen admitted, yes, he was self-employed. Thank you very much for this information. And here's the link right here where you can look it up on the SSA website. You can go back 3 years if the person is self-employed and went years and years working under the table without reporting anything. That's as far back as you can go. Now, here's a sample Social Security statement. This is what it looks like. You can download this off of the SSA website. Right here is the link where you could pull your own account statement. I suggest that you do that. You could do it for yourself. You could do it for your spouse, friend, whatever. So you can take a look at how Social Security is calculated. It shows you right here what your monthly retirement benefit will be. That's an estimate, depending on the age that you actually start collecting. And the longer you work, basically the higher this number will go, the more Social Security you will receive. Like I said, when you're 30, 20, you don't think about this very much. By the time you're 40, you're thinking about it a little bit. And by the time you're 50, you're thinking about it all the time, right? So right around then is when I start getting questions from people like, oh, I want to maximize my Social Security. What can I do? So they start to come to you with these types of questions. And maybe you're the only financial advisor that they have. Many times if a person has a tax professional, that's the first person that they go to, especially if they trust you. That you're the first person that they'll go to for this kind of advice. So I think it's good to have a basic understanding of how this works. With regards to Social Security, it's all listed on the Social Security statement, the benefits that you will receive. And then the other great benefit is a survivor benefit. A survivor benefit is if you have, small children, especially, and if you have a parent that passes away and would have qualified for Social Security, then the children are eligible for a survivor benefit. Like if I were to die now, I had my children late. If I were to die now, my children would get a very nice survivor benefit. Let's just put it that way. And they'll be able to receive that survivor benefit basically until they're out of high school. It's like basically a really nice life insurance policy for yourself while your kids are small. Now, if you look right here, it's kind of cut off a little bit, this image, but it shows the year on the left-hand side, the year that you worked, basically, the earnings that were taxed for Social Security, payroll tax that you had to pay, and then the earnings that were taxed for Medicare, which began in 1966. You can see that. Your Social Security statement is going to look similar to this, and it's going to show the years that you worked and how much was taxed for Social Security. And then it will also tell you your estimated benefit based on your retirement age. Okay, and of course, this can fluctuate based on if your income goes up or if your income goes down. If your income goes up, you're going to be funding your Social Security more. If your income goes down, you're going to be funding your Social Security less. But obviously, if you have a zero, like a big goose egg, for any number of years here, then you're not going to get any Social Security credit for those years, and it can really affect your monthly retirement benefit. Now, this is what an earnings record looks like when there's years of either unreported self-employment income or years that the person didn't work. As you can see here, this is an older Social Security statement. They don't look like this anymore. But back in the early 2000s, this is what they used to look like. Now they're redesigned, a little bit snazzier graphics, and they look like this. But the information is basically the same. And as you can see on this earnings record, the person didn't work or didn't report any earnings for 79, 1980, 81, 82, 83. So that can affect their monthly benefit because these zeros give you zero credit. Social Security has to take, the 35 highest years in order to basically figure your Social Security benefit. And if some of those years that are being figured in are 0 years where you have no Social Security or no Medicare paid in, then it's going to lower your benefit amount. And if it is a person who's self-employed, like that example that I showed you, then there's only a certain amount of time that you can go back and correct it. And you got 3 years, basically. That's it. Those 20 years that he didn't file and report, if he would have even filed and reported just a few $1,000s of self-employment income, I'm serious, even just a few $1,000s of self-employment income, paid a few $100 in self-employment tax, but he didn't do that. He was like, oh, I'm working under the table, I'm not going to pay tax. Yeah, I've seen it, let's say, at least dozens of times now. I even had a family member that did this in the 90s. And I got him on the straight and narrow. And, he's in his 70s now. He's been he's been straight as an arrow for like the last 15 years. Got in trouble with the IRS back in the early 90s. But he's been as straight as an arrow for the last 15 years. I straightened him out. And now, he's in his 70s and he's getting a really nice Social Security check. So I know he's happy about it. But a lot of times people don't get good financial advice or good tax advice, or they don't ever even research this a little bit. And then they get close to retirement age, they pull their Social Security record, or they go down to the Social Security office in person. That happens too. And, the operator there or the person who's working at the Social Security office will say, you don't have enough quarters, or you have 20 years where there's nothing there. You just didn't work for 20 years. And they'll say, oh yeah, I worked, but I just didn't file tax returns. There's nothing you can do. You can correct the last 3 years, but you can't correct 20 years. It's too late. They screwed the pooch. They screwed the pooch. I know that many of those people would be really happy with $2,000 or $3,000 in retirement every single month. And they're not going to get it because they didn't report any income for years and years and years and years. Now, the last thing I'm going to talk about is the Form W-4V. This is not the same as the Form W-4. Many of you are familiar with that form. The W-4, without the V, is Employee Withholding Certificate. That's what the employee fills out and gives to their employer, basically their boss. So their payroll department knows how much to withhold from the employee's paycheck. This is a little bit different. This is completely optional for people who want to withhold a little bit of tax from their Social Security benefits. This is what I've always used it for, what I've always recommended it for. You can actually use this form to have voluntary withholding taken out of your unemployment compensation or any of these other types of income sources. But I've always used it for my retirees that are receiving Social Security and don't want to pay estimates. So you could use the Form W-4V to withhold a certain percentage from a person's Social Security. And if they have other income coming in, for example, I have a lot of retirees that are receiving Social Security, but they have other income sources too, several of whom are still working. They're still working, either part-time or even full-time, but they're, 70 and they're getting Social Security as well as earning wages. But they want to have a little bit extra withheld so they don't owe at tax time. So the Form W-4V is for that. And the way that you do it is you just download it off the IRS website. It's the W-4V. This is for anybody who doesn't want to pay estimates throughout the year and they're receiving Social Security. And you can just have the withholding taken out of your Social Security automatically, and you don't have to pay quarterly estimates. And a lot of retired people, they don't know how to use direct pay. They don't know how to navigate the IRS website. I think that this is safer for them to just withhold a little bit from their Social Security. Once you fill this out, it's just automatic. The Social Security Administration will withhold whatever percentage you put down here, and you could choose 7, 10, 12, or 22%. And you just put the taxpayer's name and their Social Security number, and you could start it at any time. You can also file this form to stop it at any time. As you can see right here, I want you to stop withholding federal income tax from my payments. And the way that you submit it is you just fax it. The link is right here on the SSA website. You just fax it to your closest Social Security office. You can mail it too, but usually I just fax it in. I have a fax machine. So I fax it in for the taxpayer, and all they have to do is just sign and date it. And this is what I recommend for my retired people that have Social Security if they do have to pay estimates, rather than paying estimates, is to just do this. So then it's automatically withheld, based on whatever percentage you think you need them to withhold. And that's it. Makes it a lot easier for them. That's the end. Make sure to check out our other educational webinars.